It is the single largest expense of a modern life, and yet most people understand it only as a subtraction, a penalty, a bill that arrives on April 15th. They see taxes as a reduction in their personal income, a claim on their wages by a government they feel they cannot control. This is a profound and costly misunderstanding. To see taxes as merely a cost is to see only the surface of a deep and powerful mechanism.
Across the nation, Americans dig way down deep for our record-breaking income tax collection. It's hard to relax with those tax forms on your mind, but don't give up.
Taxes are not simply a claim on income. They are a claim on the entire economic system. They dictate the behavior of capital, reward certain forms of ownership, punish others, and create the legal architecture that determines who becomes wealthy and who remains locked in a cycle of earning and spending. To truly understand money, you must understand taxes, because every major financial decision made by the wealthy, by investors, by entrepreneurs, and by institutions is first a tax decision, cloaked in the language of business strategy. Consider the fundamental difference in how an employee and an entrepreneur view the world. An employee receives a salary, and from that gross number, a significant portion is immediately withheld and sent to the government. The remaining net amount is what they use to live, save, and invest. Their wealth is built on the foundation of after-tax income, and their marginal tax rate is the single most important factor determining how much of their labor's reward they get to keep. For this person, taxes are a direct cost of working. Now consider the entrepreneur who builds a company. They do not primarily pay themselves a large salary. The wealth they accumulate is held in the equity of the business. The company pays corporate income tax on its profits, but the entrepreneur, as the owner, does not pay personal income tax on that profit until it is distributed as a dividend or until they sell their shares. This is the first revelation. One can defer, transform, and even eliminate tax liabilities through the legal structure of ownership. The money is still theirs, but it is not yet income in the way the tax code defines it. It is capital, and capital is treated with a deference that wages are not.
In 2024, the federal government collected $4.9 trillion in revenue. That's a 4 and 9 and then 11 zeros. 99% of that money comes from taxes. And the biggest sources of taxes? 1, individual income taxes, $2.4 trillion. That's 49% of all the money the federal government takes in. 2, payroll taxes, $1.7 trillion, or 35% of the total.
This is where the tax code reveals its true nature. It is a system of incentives disguised as a system of collection. The government does not simply want to take money, it wants to shape economic behavior. It uses tax policy to encourage investment, to promote homeownership, to incentivize research and development, and to reward long-term holding of assets. The wealthy and the sophisticated simply read this map more carefully. For example, the tax rate on long-term capital gains, the profit from selling an asset held for more than a year, has consistently been lower than the top marginal rate on ordinary income. This is not an accident. The system is designed to favor patient capital over active labor. An investor who makes $1 million in salary is taxed at a higher rate than an investor who makes $1 million from selling stock. The code is telling you that the movement of money through ownership is more valuable, and therefore more worthy of preferential treatment than the movement of money through a paycheck. The most powerful mechanism within the tax system, the one that truly separates the wealthy from the rest, is the ability to use debt as a tax shield. If you borrow money to buy an asset, the interest you pay on that debt is often tax deductible. This is not a loophole. It is a fundamental principle of how the system encourages leverage. A billionaire does not sell stock to buy a house. They borrow against their stock portfolio. The loan provides them with cash to live on, and the interest they pay on that loan is often deductible if structured correctly. Meanwhile, they do not trigger a capital gains tax by selling the stock, and they do not generate taxable income. The asset continues to appreciate, and the debt remains a permanent and elegantly tax-free source of liquidity. This is the inversion of the ordinary understanding of debt. To the average person, debt is a burden, a monthly payment that eats away at their net income. To the wealthy, debt is a tool that converts an asset's future appreciation into present-day cash, all without triggering the tax man. This is the core reason why many ultra-high net worth individuals pay a lower effective tax rate than their secretaries. Furthermore, the tax code is the language in which the world's most powerful financial institutions operate. Private equity funds are structured as pass-through entities, meaning the fund itself does not pay corporate taxes. Instead, the profits flow through to the limited partners, the pension funds, university endowments, and wealthy families, who pay taxes on their share of the income at their own individual rates. The fund managers, or general partners, are compensated through a structure known as carried interest. This is a share of the profits, but for tax purposes, it is often treated as capital gains rather than as ordinary income. This difference can amount to hundreds of millions of dollars in tax savings for a single manager over their career. This is not an accident. It is a codified incentive to attract the most aggressive capital allocators to the private markets. It encourages them to pursue long-term value creation in private companies rather than short-term trading in public markets. But it also creates a system where the rewards from managing other people's capital are taxed more favorably than the labor of the people whose pension funds are being managed. This logic extends to the very bedrock of family wealth. Consider the role of the estate tax, a levy on the transfer of wealth from one generation to the next. A family worth $200 million does not simply wait to die and let the government take a significant portion of their legacy. They employ a battery of lawyers and accountants to design a structure that legally circumvents this tax. Trusts are established. Life insurance policies are purchased with trust-owned structures. Assets are gifted to future generations at a discounted value. These are not acts of evasion, they are acts of legal and strategic planning. They are a testament to the fact that the wealthy do not view the tax code as a static obstacle, but as a dynamic game board. Their entire financial architecture, from the way they hold assets to the way they transfer them to their children, is built around the rules of taxation. The goal is not just to accumulate money, but to ensure that money is preserved, perpetuated, and passed on with minimal leakage. The global dimension of this is equally critical. A multinational corporation does not simply pick a country to do business in, it picks a tax jurisdiction. The company will structure its global operations so that its intellectual property, its highest margin revenue streams, are owned by a subsidiary in a low-tax country like Ireland or Singapore. The profits from sales in high-tax countries like the United States or Germany are then licensed from this low-tax subsidiary, effectively shifting the profit center to a place where it is taxed at a single-digit rate. This is not illegal. It is called transfer pricing, and it is the accepted practice of global commerce. It demonstrates that for capital, national borders are not barriers but opportunities. A small business owner in a local town is locked into the tax laws of their state and country. A global corporation can choose its tax home, selecting the rules that offer the most favorable treatment. This is the starkest illustration of the power dynamic. One party pays the tax that is assigned to them, while the other party chooses the tax they are willing to pay. To ignore the tax code is to ignore the rulebook of the game. The financial media, personal finance gurus, and motivational speakers often focus on gross income, on the thrill of the big salary or the high-value IPO. But a sophisticated understanding of money requires looking past the gross number to the net, and past the net to the structure. Two people can both earn $1 million a year, but one might be a salaried executive living in a high-tax state with a simple portfolio of taxable stocks. The other might be an entrepreneur who owns a business, uses leverage to finance real estate, and has structured their holdings to allow for significant charitable deductions. Their total net worth will diverge wildly over a decade, not because one is a better investor, but because one understands that taxes are the single greatest variable in the formula of wealth creation. The first individual is playing the game of earning. The second is playing the game of structuring. One is paying a tax on their activity, the other is designing a system. The most unsettling aspect of this entire system is how deeply it is embedded in the law and how completely it is accepted. The tax code is not a conspiracy against the middle class. It is a collection of rules created over decades by legislators responding to a complex set of economic, political, and social pressures. The preferential treatment of capital gains, the deductibility of mortgage interest, the deferral of taxes on like-kind exchanges of real estate, the exemption for municipal bond interest, the estate tax exemption, the carried interest loophole, all of these are intentional policy choices. They are not hidden, they are published in the United States Code, available for any citizen to read. But they are written in a language so dense and complex that it requires a lifetime of study to truly master. The wealthy do not possess a secret, forbidden knowledge. They simply have the resources to hire those who do. They pay for the map, and the map tells them exactly which paths are safe and which will lead to a tax liability. This is why taxes are not merely a matter of personal finance. They are a matter of power. They determine the relationship between the citizen and the state, between the worker and the owner, between the present and the future. They influence everything from the price of a stock to the construction of a skyscraper. The decision to build a new factory, to hire 10,000 workers, or to launch a new product line is often predicated as much on the tax implications as on the market demand. The tax code creates winners and losers before a single product is ever sold. It decides that one form of economic activity is patriotic and worthy of subsidy, while another is merely a transaction to be taxed. Understanding this is to understand that wealth is not simply accumulated, it is engineered. It is built on a foundation of law and accounting that is just as important as the foundation of brick and mortar. The richest people in the world are often not the highest paid, they are the best structured. The tragedy for the average person is that they are taught to see the tax system as an unavoidable evil, a simple deduction to be endured, a civic duty. They spend more time planning their annual vacation than they do planning their tax strategy. They fill out the standard deduction because it is easy, not realizing that itemizing could unlock a world of deductions for charitable giving, state and local taxes, and investment expenses. They view tax avoidance as something sinister, something reserved for the corrupt, unaware that the law itself is built to encourage it. The Internal Revenue Service provides a manual for the optimization of one's tax affairs, and the most successful people in the world have memorized it. They know that the goal is not to pay zero tax, as that would invite scrutiny and legislative backlash. The goal is to pay the minimum amount required by law, and to do so through structures that are so common, so ordinary, and so deeply embedded in the system of commerce that they are considered not only legal but prudent. In the end, the story of money is inextricably linked to the story of taxation. A financial analyst can read a company's earnings report and tell you if it is profitable. A true financial historian can read a company's tax return and tell you how it is truly managed. The tax return reveals the location of the profit, the nature of the expenses, the rate of depreciation, and the composition of the debt and equity. It is a map of the business's soul. The same is true of a family or an individual. The tax return is not a biographical summary of their life. It is a technical schematic of their financial existence. To look at someone's tax return is to see what they own, what they owe, what they prioritize, and, most importantly, what they have structured their life to become. Understanding money is not about earning more. It is about understanding the rules that govern everything you earn, everything you save, and everything you leave behind. Until you understand taxes, you are not playing the game of money. You are merely contributing to it.